Hi, Greg Weldon here with Weldon Live. This is the light edition for Thursday, May 17th, and it's kind of back to the U.S., all right? And today is one of our favorite days when we find out that, yes, the Fed has released their quarterly U.S. household debt and credit report and their household expectations and sentiment survey. Really deep down stuff to dig through, man. I really enjoyed the morning dissecting this data. I know that sounds totally perverse, and what a life I must have that this is what I derive passion about. But it is. There was really good stuff in here. At the end of the day, we'll make it really simple. I mean, we could just do maybe 30 seconds here and do a mic drop and be done and take the rest of the night off. Rare that we be done here before 7 o'clock at night after being up since 4. But at the end of the day, it's really about a new high, record high in U.S. household debt, 13.21 or 12 trillion. Either way, more than half a trillion above the 2008 high. So we are now at new highs by far, okay? And it comes at a time where we're seeing delinquencies rise, particularly in credit cards and auto loans, and even to the degree of extremely delinquent, 90 days or longer. So that's interesting, number one. We also note in the context of consumer expectations, two things. Number one, less bullishness about the stock market and more bullishness about inflation, okay? And that ties into fixed income and the rise again today in the 30-year amid curve steepening. Foreign exchange today, we look at the yen. Don't know if I included that here in the light. Possible short position on the back of our discussion last week on the BOJ and the April meeting. And then stock indexes, we look at energy and a potential wild card kicker we want to add to our XLE in the frac. Let's break it down. All right, here we go. An increase of $63 billion in the first quarter takes the versus the fourth quarter anyway, and total household debt now at a new record high, 13.21 trillion, which is a half a trillion higher than the previous peak. Okay, relatively speaking. Number one. Number two, delinquency rates. Okay, on the rise, particularly in credit cards, auto loans, even a little bit of an upturn in home equity revolving credit. Okay, and then 90 days late, credit cards and auto loans, and look at where credit cards are. I mean, this is above 7%. Okay, and then seriously delinquent, 5% on credit cards, new high. I mean, multi-year high here. Even again, home equity revolving loans turning up, and although auto loans here were down a touch, they're up from the lows, notably as we make new highs in total auto loans. Now, in terms of the household expectations survey, really like this one. Expectations for household income growth, new high. All right, so there are some places where households are very confident. Income growth is one of them. However, we break that down in terms of income and expectations of income growth. And the wealthier you are, above $100,000 in annual income, you are the most optimistic. Whereas those below $50,000 and $59,000 is the average annual income in the U.S., so the under 50, is below average, although it encompasses probably half of the population. They're not so optimistic, and it's a full 1 percentage point difference. And before you think that's nothing, that's 50% difference between these two readings. That's massive. It's been bigger, but this is the same type of thing. The rich get richer, and the poor get poorer. And at the bottom end, this is where the credit card debt is being expanded the most because they don't have money to pay their bills, because their income is not growing fast enough, and their debt has to grow faster than income, or they can't make ends meet, even with the tax cuts. And we're going to be interested to see whether that was the case, and it is the case, at least so far. We see the overall household conditions, though. Again, here's a sign of optimism. People do feel better about the future going forward. You have more people saying things are better off, and they expect them to be better off going forward, versus not so many worse off, and in fact, very few saying much worse off. So in the middle, those saying it's the same, decrease, because it's going to the top end where people feel better about their current situation and, in this case, the 1 year ahead expectations for their financial situation. Now, it's interesting to note the erosion in the bullishness around the stock market. Probability the stock market will be higher a year from now, down, and when we do it by income level, you can see the less affluent are the most bearish, though really would say the least bullish, better way to look at it. But all income levels are down. And look at the wealthiest. All right, this is the least bullish they've been since 2016, since Trump got elected. So that's something big to note. And it hasn't jumped because of the tax cuts. No, not at all. This made the high before the tax, just when the tax cuts came in, and then boom. Since then, with the actual tax cuts, feeding into the consumer and money, we don't see much impact in terms of retail sales. It's still being dominated by price increases in grocery store sales and energy, as we looked at yesterday or 2 days ago. And even in terms of education level, down across the board, and especially those, earning more and those with a higher degree of education are the least bullish they've been since Trump got elected. That's important to note. And probably more important to note, and we go back to Yellen and talking about inflation expectations remaining anchored, and she was afraid they were going to be unanchored potentially to the downside, and how they wanted to become a little more embedded on the upside. And we did our anchors away piece. Well, here we can do anchors away again because, it looks like inflation expectations are being unanchored to the upside. And this is kind of what the Fed wanted, more embedded thought process around inflation. But is this what you really want? Because what that means is, okay, with income growth not matching credit growth, which is an indication of stress, and with the fact that food and energy prices are rising and becoming, an increasing impediment to expansion in discretionary spending, particularly in eating and drinking establishments, as we have clearly shown, okay, a rise in inflation is only going to cause the further retrenchment by the consumer. So, is this what the Fed wants? Again, we can't help but think stagflation. But at the end of the day, 2.98 is the 1 year, which is now above the 3 year and at a 2-year high. And when we look at it from this perspective, a little bit of a different chart, a 50 basis point increase in September, we wonder, are you becoming unanchored to the upside? 3% here. I mean, wow. And breaking out to the upside. So here again, kind of puts the Fed in the box. Not only that, but the expectation for home prices going forward is still very positive. In fact, it's at a multi-year high and breaking out as well. And that leads us to the housing data, which was not good. All right, starts down. And what's interesting is the dynamic between single family and multifamily. I mean, multifamily are down big, but single family is doing nothing. And in fact, completions of single family is down. And here's your starts, double top here, triple top here. It's gone nowhere in the last year, no growth momentum here. And here again, this is what we're talking about in terms of completions. Okay, single family completions are down 7% in 2 months. Whereas multifamily, 5 units or more, are up 22% in just the last 3 months. All right, now, that is a negative factor to some degree for inflation. It's one of the few things we see right now that could potentially weigh in inflation is more apartments being available. And we've heard about, apartment rents coming down. We did the piece last month about, apartment rents in New York City, in Queens, in Brooklyn, and in Manhattan, how they're coming down hard across the board. Well, this is one of the reasons. I mean, you're building a ton of apartment buildings, and it's reflected right here. 22% completions in the last 3 months. On the other hand, where you need new single-family homes, where it's crimped the market in terms of affordability, in terms of being able to put your house in the market because you might not be able to find a new house to buy, lack of inventory, So down 7% in 2 months and 4% in the last month in terms of single-family unit completions. This is not good. None of it. All of it. Now, in terms of industrial production, these numbers were strong. Across the board strength. Look at consumer goods. 1% up 0.9 here. Final products up 1.1. Business equipment up 1.2. I mean, it's across the board strength. Mining, utilities, everywhere was strength there. And everywhere was an increase in capacity utilization with the headline number at 78, to the point where you do start to think, okay, we know that capacity utilization is different than it used to be. It's been hollowed out, the industrial sector here in the U.S., and it's not as important as it used to be as an inflationary indicator. That's not to say it's not important. Particularly with capacity having been expanded, the fact you're eating up capacity utilization here and you're back to 78%, we said the closer you get to 80, the more inflationary pressure this does reveal, because it is really saying you don't have excess capacity as a kind of a resource dynamic that will hold inflation down. So interesting in terms of this. And then in terms of the Empire State was also interesting. Yes, current conditions bounced, but really it was about prices. Prices received rose 2 points to 23. Not only that, it reached a new high. And you saw prices paid. So it's like you're able to pass through some price increases, but margins are still getting hit. So it's margin compression, stagflation. I mean, it has all of these things written all over it. But really interesting to know prices received on the back of expectations by consumers of a 3% inflation rate. Man, this is why the bond market was down again today. Okay, we're seeing increasing signs that inflation's picking up to the point where the long end is concerned, and or both potentially, or that the Fed's losing control of the bond market here. Just given the sheer size of the debt, and again, the CBO just increased their estimate literally just a few weeks ago from 30.7 trillion in the next 10 years to 33.2 trillion. 33 trillion in U.S. public debt. You thought 21 trillion was huge. You thought 10 was huge. 33.2. And here you go, 30-year bond, new low, expanding, extending, confirming the breakdown, and the yield now above its pivots here. This is it, the big kahuna. The big kahuna breakout in the bond market is here. We need to get involved. We want to see a little bit of a rally. It's just how many days down? I mean, tough to sell it in the hole here against this. We want to see some kind of pullback. It gives us another potential pivot to play off as a stop. We'll see. Hopefully we're not chasing this move, next week. We'll see what happens. And here in the context of the curve steepening. I mean, the 2-year was actually down, and the 30-year was up. So it's another 4.5 basis point, almost 5 basis point widening in the curve on top of 4.5 2 days ago. It's 10 basis points right there on a curve that was already, flattened into something like 70 basis points. That simply is a big moves going on. And now, finally, to get to energy and check out the end charts and in the live, but really here in terms of energy, we have another position. So we're going to cover this. XLE, well positioned here. I mean, really continues the gel. We're long. It's right there. It's right there. And this is such a rock solid underlying structure for a breakout here. Okay, but ExxonMobil continues to underperform. I mean, this stock is still $7, $8 away from its breakout pivot, from its downtrend line. It's just barely getting above the 2-year moving average here. Now, it has a nice structure, so we still like the XLE, but we also like the frac. We always want to like the frac. And in this case, it is breaking out. It's really building on last week's breakout. It got above this 1710 level. This week, it's violated the trend line. It's above a 2-year moving average. It's now turned up. Both of our both of our long-term oscillators are bullish. And you don't see ExxonMobil anywhere on the top 10 list. We look at 3 of these in the full live, all of them great, charts, and we start in terms of the light, we look at one of them. That's the top holding, which is Occidental. Does this look like ExxonMobil? No. This is why we want the frac 2 as a kicker, not necessarily the same size position. You got to adjust that. But, I mean, look at this double bottom at the 50% retracement. And this breakout now on the monthly chart, frac looks good. These individual components look really good. Look at, Anadarko, for example. I mean, what were some of the other ones? And in Marathon. Even Apache, what hasn't yet broken out, is right there. It's like the next one to go. So you have some real fodder there for further bullishness, and thus we want to add the frac to our long position in energy to the XLE and the gasoline. Only things we're kind of, we're watching sugar here, watching obviously the soybean meal and the corn, but other than that, for now, standing pat.